Hello everyone, I'm Conray. Welcome back to the channel. So in today's episode, I'll be talking about a few different things. So number one, it'll be the stock selling off, the entire market selling off. Second of all, it's on a stock that I've been trimming. And lastly, it's a stock that I've been adding into my portfolio over this past few days. Okay, so first of all, let's talk about the stock market selling off. So the markets are around 5 to 6% down from the all-time highs, and your fear and greed is currently at extreme fear. Your market participants are currently fearful that this Israel war can just continue causing your oil prices to go up, hurting macro conditions. And then your inflation data wasn't particularly favorable to the markets as well. So your PPI came out and it was around 3.7% if I'm not wrong. So for me, I'm not a macro investor, so I don't really look at the macro data. Of course, it can be leading indicators for the entire market as a whole. I'm more bottoms up, but the macro environment now is a situation of uncertainty, of course. So you have the war that is causing uncertainty. You have your inflation that is causing the Fed not to be able to cut. Jerome Powell came up yesterday. The Fed dot plot is around one rate cut this year. And there's a lot of uncertainty with respect to that as well. As for whether or not I think it's a good opportunity to add into positions, I think it's okay to add into high conviction positions. I'm only looking to add into those that I'm highly convicted in. I'll be sharing a stock that I've been adding into as well later on in the video. And to touch on specific stocks, I think two stocks that have been falling almost every single day since the Iranian and Israel war is Visa as well as MasterCard. So these two stocks, I've been holding them for quite a fair bit of time already. It is a significant position in my portfolio, and let me talk about it. So Visa and MasterCard are currently selling off. Why are they selling off? Because of the macroeconomic environment, although there's a counterbalance to it as well, which I would like to suggest later on. So first of all, people are fearful that your Iranian and Israel war will cause some sort of macro uncertainty which weakens consumer spending, thereby hurting Visa and MasterCard. But there's also another angle to this as well, which is that Visa and MasterCard are essentially inflation hedges because your inflation is directly passed through them. If inflation increases, then Visa and MasterCard's revenue will just naturally increase as well because they are toll booths to the entire economy. And so do I think Visa and MasterCard are decent opportunities to add right now? My fair value for Visa is around $374 a share. So the IRR currently is around 13%. Whether or not it is a decent opportunity to add will be up to you. That's for you to go and decide. So I would like to give a bit more color on Visa as well as MasterCard. So yesterday or 2 days ago, I actually spoke to someone at Visa. It was quite an interesting chat. So we asked him a few different questions pertaining to Visa's long-term terminal risk. So one of them was stablecoin. Second of all was your European banks coming up with a localized railway to bypass Visa as well as MasterCard. So his response to that was extremely simple. He works at Visa, so he knows things on the ground. Of course, he can be biased as well. But his opinion is that Visa and MasterCard's moat won't be displaced anytime soon, at least from his perspective. Why is that so? Because consumer behavior won't change so quickly. Second of all these things have been around for a very long time already. For example, the regulations in Europe as well as the payment alternatives in Europe have already been around for quite a long time already, and it hasn't materially hurt Visa as well as MasterCard. Second of all is stablecoin. For stablecoin, it all boils down to trust. Trust is the most important thing when it comes to paying for high-ticket items, which is what we've covered in the Substack as well. Feel free to check it out if you're interested. It's a full thesis on Visa so that you can understand how the business model works as a whole. But his summary is this. Trust is important. When you're paying for something, when you're paying using a Visa and MasterCard, you can expect a refund if something goes wrong. But if you use a stablecoin or if you use a QR code, like for example, PayNow as well as PayLah, the problem with that is that you cannot get any chargebacks. Now banks are doing it voluntarily, but what if this fraud rate balloons over time and no one's going to be responsible for it? On Visa and MasterCard, they're able to prevent it, and that is the value proposition from their end right now, besides the brand equity and the entire trust engine that the company has been building over time. So on Visa and MasterCard, this is a very short one-liner. Stock has been selling off. Do I think the stock selling off is justified? No, that's for you to go and decide. Am I actively adding into the position? Currently, no. I'm still waiting because I have quite a sizable position in them already. Next one, let me talk about stock that I've been trimming down over the past few days. And this company is none other than ASML. So why have I been selling ASML? So ASML is probably going to report amazing earnings in the next earnings call. Micron reported amazing earnings coming up, and then Micron is currently signing new deals with ASML to expand ASML's offerings over time. ASML is venturing into packaging and so on, besides the lithography as well. So why is it that I'm selling ASML despite this stellar earnings performance? Okay, so reasons for selling. Memory is a cycle, whether or not the Micron CEO comes out and say that it is not a cycle, whether they're saying that they're managing it well, all your semiconductor people, all your professional semiconductor people know that memory is a cycle. I've spoken to people in semiconductor, it's typically around a 3 to 4 year cycle. ASML has benefited greatly from it. We don't know when the cycle will end, whether or not it's going to end anytime soon. But for me, I think it's comfortable now to take profits from ASML. So the first reason is the cyclicality associated with the memory cycle. Second of all is simply high valuation. So same thing, I've spoken to a few portfolio managers and this is what they've said. There's a threshold with regards to your P ratio that you want to enter at. So there's a common train of thought that I've seen from a lot of these fund managers, which is valuation. Valuation is important because it determines whether or not you get excessive returns from the stock over time. And in the case of ASML, it's currently trading at 48 times earnings, which is not cheap by any means. So if you were to do like a projection, just some napkin numbers, assuming a 20% EPS growth over the next 3 years, you're getting subpar returns from ASML, assuming a 30 times terminal multiple. If you stretch that out to around 5 years, I believe it's around a 10% CAGR for 5 years, assuming 20% EPS growth every single year for that 5 years and a terminal multiple of around 30 times. So the stock is not cheap. And a stock is expensive for as long as the narrative holds. Once the narrative dies down, you will see multiple contraction over time. So I've trimmed down my ASML position. I haven't fully sold out of it yet. It's still a high quality business that is exposed to a memory super cycle, an AI super cycle that could continue on for the next few years. But I currently believe that valuation is overstretched and there are better ways to play this entire AI cycle if you're currently betting on it as well. And I mean, if you were to just look at FICO, for example, FICO was a stock that was trading at around 60 times, 80 times, 100 times P ratio, and people were saying that it's a compounding machine that can be around for a very long time, that is going to continually have a durable moat that can be around for a very long time. But once a bad piece of news comes out, you see what happens with stock like FICO. It can drop 50% in the duration of around 6 months. So it's similar in the case of ASML. It's a high quality compounding machine nonetheless. Valuation is high, that's why I trimmed my position. Last part, let me cover a stock that I've been adding. If you've seen the recent videos, I'm sure you have an idea of what stock I've been adding, and this company is none other than Honeywell. Okay, so let me cover a bit on Honeywell. This is a short summary on my position in it and the entire aerospace industry as a whole. So the entire aerospace industry has strong secular tailwinds and strong secular growth trends as well. So for example, this is the aerospace industry fleet growth over time. It's around 3.1% CAGR for the next 20 years. So this is higher than your average GDP growth. And if you're to add in the replacement as well, it's around 4.1% baseline growth rate for the entire industry. So in the industry as a whole is a very strong one. And we're currently still at production levels below COVID, which means the industry is still in recovery. Second of all, Honeywell is a high quality business. If you look at the entire aerospace industry, you'll find a lot of different high quality businesses in that. Why? Because in the aerospace segment, it is highly regulated. You have the FAA issuing licenses, checking through companies, making sure they go through rigorous processes of licensing their fleet. And Honeywell is the same as well. So in aerospace, the regulatory barriers are extremely high because you need licenses, and licenses will lead to around 8 to 10 years of trial and error and testing and getting the license itself. So the power of incumbency is very strong in the aerospace industry. And in your aerospace industry, the idea behind it is this. You have a plane. The plane is licensed as a whole together, meaning to say every single part in the plane is licensed together. You cannot just replace a part inside without getting a license. And that is why a lot of your aerospace industry companies are actually very strong. And that's why Chris Hohn, he owns GE, he owns Safran, he owns Airbus as well. These three aerospace companies are quite high quality also. So for Honeywell's business, it has two main portions. First one is your OE. OE means original equipments. It is the parts that they sell to the planes. Second of all is your aftermarket revenue. So aftermarket revenue refers to everything that happens after a plane is being produced that is already running. So it includes your spare parts, your services, as well as your upgrades for the existing plane. In the entire space, the ones that are leading will include RTX, GE, Safran, Honeywell, as well as Thales. These five companies are the main ones that are providing equipment to your OEMs, which are Boeing as well as Airbus. So Honeywell has strong incumbency, and it is currently in most, if not all, of your next generation aircrafts. And for your aerospace industry, your production cycle typically takes around 10 to 15 years, meaning to say once an air fleet is made, it typically takes for around 10 to 15 years for a new generation to be made. And what that means is that once your equipments are embedded in the existing fleet already, it takes a very long time for you to switch. It allows you to collect high margin recurring aftermarket revenue for the next 15 years before you have to go and fight for a platform win again. In the case of Honeywell, it is in a lot of your next gen aircraft. So for example, your 737 MAX, your A320, your A380 and so on. And that's why Honeywell's business is a high quality one as a whole. Last part, this is the catalyst that will probably unlock value for Honeywell. So Honeywell spin-off provides a platform for re-rating. So if you're to look at the companies that were rated in the past, like for example GE, like for example Raytheon, GE in 2024 was a company that was in distress, and post spin-off it is actually 3x in price. Raytheon and United Technologies, they merged together, and they're around 3.5 times in market cap cumulatively, including other companies like Otis as well as Carrier. So am I implying that Honeywell will achieve something similar as well? Possibly. But I think the more important thing to note is that your pure play companies, they provide investors with greater visibility over time. And that's why your companies like GE, like Raytheon and United Technologies forming RTX leads to multiple expansion over time, leads to re-rating of companies to levels on par with industry peers. And in the case of Honeywell, its EV to EBITDA is around 16.5 times, which is below the sector median of around 18.2 times. So despite the company being better than average as a whole, the company is currently at a discount relative to its industry peers. So that's why I feel Honeywell is a decent company to look at, especially with this spin-off coming up. Seth Klarman has spoken about this before in his books on spin-offs. This is slightly different because Seth Klarman looks for spin-offs that are highly distressed. But nonetheless, I think Honeywell is a decent company to look at right now. I've just added into the position. As for some comments that I saw in the previous video on Honeywell, which is Honeywell fighting with your OEMs and your OEMs basically hurting Honeywell's margin over time. Well, it's possible, it's a tangible risk because your OEMs, they need to optimize for costs, and your OEs, they typically sell at very low margins to your OEM anyways. With response to that, Honeywell's current incumbency in a lot of your next-gen fleets is the solution. Aftermarket revenue is the one that is driving the earnings for Honeywell anyway. So it is unrelated to the initial OE sale. Okay, last part. If you guys are interested in any companies, please feel free to leave it in the description below. We release newsletters, write-ups, interesting investor letters on our Substack as well. It's the link in the description. Feel free to check it out if you're interested. And the last company that I would like to talk about is Airbus. If you guys are interested in this one, I will delve deep into it and explain the entire business model. I think Airbus is a decent quality business. It's the top of the funnel in the entire aerospace industry. And there's a few clean catalysts coming up. Of course, there's a lot of mess as well with their Pratt & Whitney engines and all that crap. So if you guys are interested, I'll do a video on that. Otherwise, leave some comments on what videos or what stocks you're interested in. I hope you guys have found this video useful. And yeah, stay tuned for the write-up on Honeywell soon.